Thank you. Morning, ladies and gentlemen. Just by way of introduction, Maya Resources, we listed on the Australian Stock Exchange in September 17. Been operating in PNG now since 2012, with, I guess, a vision to originate projects across three key portfolio areas: industrial minerals, lime and cement, energy, and then most recently we've actually just divested our copper gold, and I'll go into that. So our business model has been to identify highly exploratory areas in PNG, and then I guess progressively take them down the commercialisation pathway. It's funny, I get asked about PNG and why companies trade at such big discounts to the rest of the world, and our experience in PNG has been fantastic. But I will say this: we made a strategic decision to stay out of the PNG Highlands. If you look at our project portfolio, whether it's copper, gold, lime and cement, or industrial minerals, they're all coastal, located or on the islands. And we've been very successful, and I would challenge any Australian company to have been able to take projects from literally discovery, origination, through to full permitting in under 4 years, which is what we did with the lime and cement project, and our industrial sands project is about to be fully permitted as well. So let me get into the guts of the presentation. I'm sure you've all read the disclaimer. So the business now is, we're starting to simplify the business. I guess one of the facts about Maya, we are a multi-commodity explorer developer. In some ways, you could probably think about our company as a company that is very good at originating projects, is extremely good at its PNG progression right through to full permitting and getting projects shovel ready. And what our strategy is, that once we're at that stage, we are now looking to at least give us the option to look at either spinning out, divesting that project so it goes into a standalone company. And we've just done that with our copper gold, and we're looking to do it with Maya Industrials as well. And I'll talk a bit more about that. Just in terms of the corporate overview, just very quickly, company's market cap's 52 million. 217 million shares on issue. We're trading at 22 cents. Just as a bit of a reference point on price, there's probably about 3 lots of broker research that have our price target on a discounted risk-weighted basis, sort of between $1 and $1.40. On an unrisk-weighted basis, certainly well over $2. So here's for me to say, but I think we're very cheap, and one of the reasons we're cheap is probably because of the sentiment towards PNG, which is baffling us a little bit, given our experiences in PNG have actually been terrific. And I think people do get confused between some of the difficulties that they've observed with companies, say, in the Highlands versus doing business elsewhere in PNG. Why invest? Well, look, if you share the same vision as us, we plan to have an iron ore business in production by the middle of next year, once we spin out Adyton Resources, which is our industrial sands. This will be a business producing 500,000 tonnes of magnetite, so it's not going to be your next BHP or Rio, but when you're selling iron ore at over $200 a tonne and putting it into China for 40, even with our pricing discounts of, say, 25%, so closer to the Platts 57, it's a $100 a tonne margin business producing 500,000 tonne a year. Work out the maths yourselves, and it's only 21 million US capex estimate. So with a payback of less than 12 months. Keep your eye on that one, but just the investment thesis on that alone more than justifies our market capex, putting aside the cement and lime project. Our primary projects, in terms of where they are geography-wise, the iron sands project I just spoke about in the Gulf province, PNG, not far from Kerema, as I mentioned, coastal. Why we like it: zero strip ratio, at surface mineralisation, right next to the Muro River and the Parari River, which allows you to very cost effectively mine, process with nothing other than spirals and limbs, produce a concentrate product of about 57% Fe, put it onto barges and then transship to ships. So that's our business model, very low capex, akin to, I guess, how a lot of the Indonesian coal mines got up and running. Central Cement and Lime Project, 25 kilometres from Port Moresby, and about 7 k's or 12 by road from the $19 billion ExxonMobil LNG plant. Why is all that significant? Well, obviously lime needs energy, and we have an MOA now in place to get access to domestic gas obligation fuel from the LNG project through Kumul Energy, the state-owned company. We're still working with them in terms of transport logistics, whether we go down a CNG or a pipeline path, but the fact is the pricing is very attractive, and it provides a very useful alternate for us when we based our feasibility study on coal. So all our kilns will be dual fuel and be able to switch to gas as soon as that's available, which puts us in a very favourable position from an ESG perspective. Just going further sort of down the coastline past PNG, we've got a very interesting early stage project called Amazon Bay. It actually sits in the Maya Iron portfolio. Why I say it's interesting, historical test work and metallurgical work has shown that it can produce up to a 1.3% vanadium pentoxide and as well as over 20% TiO2, titanium. Now, of course, the challenge with those sorts of projects is how you split the atom, so to speak, and separate the vanadium from the titanium and the iron units. So we're watching very closely on some of the developments there, for instance with TNG, because that becomes an enabler to change projects like this from being pretty well worth a few $1 million to literally billions of dollars. Again, zero strip ratio, all that surface mineralisation on the coast, so very nice, easy access way to future markets. On the energy side, I guess up in the next to Lae, you'll see on the map there, we've got our Lae Environmental Energy Project, which is a 52 megawatt power station. The whole concept around this project is really around vertical integration, using PNG's own resources of coal and biomass to generate power. For those of you that aren't familiar with PNG only 13% of the population have access to power. The cost of power is more than 30 US cents a kilowatt hour. Lae suffers daily, if not hourly, from power blackouts, a dirty power grid, and most of the businesses, I mean, I did a circuit around Lae pre-COVID, and all the large businesses are basically running off their own gensets because of the unreliability of power. I mean, one of the biscuit makers said to me, well, what do I do, Tim? I've got a half-baked batch of biscuits and the power goes off. I've got to throw them all out and start again. So it's a project that on any sort of strategic rationale makes absolute sense for PNG. And we are working very diligently now to take it to the next phase, which will be a power purchase agreement with PNG Power. So keep an eye on that one. Just in terms of the disaggregation strategy, as I mentioned before, we are simplifying the portfolio. We're very good at origination and taking projects to a point where they can stand on their own 2 feet. We've demonstrated that with Adyton. Adyton was spun out in February on the TSXV. It has completed a bit over 3,000 metres of drilling on Ferguson Island and just commenced drilling over the weekend on Fenny Island. We're hitting tremendous intercepts on Ferguson, and we certainly expect to have a significant re-rate in our resource scale and grades on Ferguson and the mineralisations at surface. So please have a look at Adyton, TSXV stock code ADY. You know, just in terms of trading multiples, it's trading at a enterprise value over resources multiple of about 6. compared to the industry average for pre-production similar companies of over 100. So we just think we're trading at a ridiculously cheap multiple. We're on an island. We've completed a program on time, on budget, with no issues from any of the landholders who are so keen for us to actually go up and develop a project there. The next stage of unlocking value is the spin out of Maya Iron as Ortis Resources, and I'll go into the detail of that in the presentation. And then our third pillar of spin-out will be the Maya Lime and Cement project, as the introducer spoke about lime, which will ultimately leave Maya as fundamentally an energy business, and I can talk a bit more about that as well. So just very quickly, in the interest of time, on Adyton, spun out in February. We raised 10.5 million Canadian dollars. We had everything prepared, all the ground ready, all the landholders ready. They literally mobilised to site 2 weeks after the IPO and commenced drilling. You can see we've done, I think, 3 lots, if I'm stand to be corrected, maybe 4 lots of announcements. So as the drill core gets to the labs, we're doing announcements. There should be a couple more coming up in the next few weeks. And we're certainly exceeding most of the historical drill results. So we do expect a major re-rate in terms of the resource and ultimately reserve statement there. Just moving on. To the Central Cement and Lime project. This is a project that's 25 kilometres from Moresby. And it's a very interesting and different project for PNG. So we've typically looked at what we can do in PNG that adds value in country rather than just mining a mineral, putting on a ship and taking it somewhere else. And that it's the same thematic as what we've got with the power project. So we've got this incredible lime resource, more than 380 million tonnes, all drilled to JORC standards. On the coast, next to energy, next to deep water, a combination that's actually extremely hard to find. I mean, let's be honest, lime is not necessarily a rare commodity, but high-grade lime suitable for producing quicklime and hydrated lime, next to energy and next to the coast is an extremely rare combination. So that's our strategic advantage. It's fully permitted. You know, as I said before, from discovery to full permitting, environment permit, mining lease granted 12 months ago was basically 4 years. So our experience in PNG is if you're diligent, you're working closely with everyone up there, you can actually get things done at a very, very fast pace in terms of the development cycle of resource projects. The next phase for this project, so as I said, we're shovel ready and we're now working with offtake partners and strategic partners to finance the project. We've also changed slightly the development sequence of the project, whereby, let me just go forward, whereby we're going to develop the project in 2 phases. Quicklime being phase 1, 2 quicklime kilns producing 400,000 tonnes a year of lime. And the markets for that lime is 1, PNG. PNG imports from North Asia about 200,000 tonnes of lime right now. That's all the big gold projects, Lihir, Simberi, K92, etc. And then the second kiln is destined for the Australian market, which is about a 2.5 million tonne lime market. Let me just say why we really like the lime industry. It's a little bit of a forgotten commodity, but for those of you, and I'm sure many of you are bulls when it comes to nickel, when it comes to copper, when it comes to lithium, when it comes to rare earths, when it comes to cobalt. Well, let me just remind you that the one ingredient or consumable required to process and produce any one of those metals that arguably is part of the energy storage and energy revolution that the world's going through needs quicklime or lime as part of a key consumable. So we see that lime will now go through a multi-decade long run of demand growth, well in excess of GDP growth on the back of the development of a multitude of projects in the battery mineral space around the world, whether it's in our region, in Western Australia, New South Wales, or for instance, New Caledonia, which is a big nickel precinct and consumes huge amounts of lime. So we really like the lime space. The capex for that project is not too big a bite. It's only about 100 million. And you're going to be producing around about 12 to 15 million US dollars EBITDA per kiln, so about 30 million per kiln on 100 million capex spend. So it's a very interesting project for us, can provide long-run revenues and returns to shareholders, and a project that we're really excited about developing. And not only that, because you're value adding through the lime kilns in PNG, has a tremendous sort of country building element to it as we bring in roads, power, water to the local village, which currently has none of the above. Look, I've spoken about the returns there. This is actually the returns based on the full project development, including the cement kiln, the clinker kiln, which is part of phase 2. Suffice to say, the returns are extremely attractive, and the resource base being as large as it is would enable a project to operate for well in excess of 100 years, generating around about 350 permanent jobs and many thousands of spin-off jobs for the country. So it's one that the provincial government, the national government, the Australian government is all behind. So yeah, please jump on our website and have a look at that. And if you've got any further questions, happy to take them at the end of the presentation or at our booth here. Look, I'll skip over that. I think I've covered the key elements around the market. As I said, the great thing about this project is there is an existing market, not only in PNG, but an existing market in Australia today. But further to that, it is a market where we see a multi-decade run of growth, particularly in the lime sector, on the back of the energy revolution. The great thing about the project in terms of its other advantages is its freight advantage into Australia. So Australia is now importing more than 50%, or about 50%, I stand to be corrected there, of its cementitious needs, whether it's clinker or cement. Australia historically used to produce all its own clinker requirements, and obviously you grind clinker to make cement. But progressively, given many of those kilns were built post-war, 50s and 60s, as they've reached their useful life, they're being mothballed and shut down. And all the big players, whether it's Boral, Cement Australia, Adelaide Brighton, or the independents like Wagner, Gun Lake, South Australia Premium, they've all moved to an import model. If you wind the clock forward 10 years and you're any one of those companies, where are you going to buy your clinker or cement from? Are you going to buy it from Thailand, Vietnam, 8,000 kilometres away, or are you going to buy it from a clinker high grade producing to Australian standards, 2,000 kilometres away on your doorstep, where the government to government relations are as tight as can be, a country where we fought side by side in the Second World War? I think it's a no-brainer where people will choose to buy their future cementitious needs from. This just is a chart that shows the growth in imports, which I've already spoken about. So about a 15% year-on-year increase in imports of clinker. And further to that, if we go to the next chart, that's the cement imports. So those of you that may not be familiar with the industry, just by way of recent examples, the Brickworks company led a consortium and just recently commissioned about 6 or 7 months ago a 250,000 tonne powdered cement import terminal in Brisbane. We're seeing another powdered cement import terminal being built in Wollongong, led by Gun Lake. We expect, and industry knowledge is suggesting that there'll be another one going in Melbourne and potentially one in Adelaide. The die is cast in terms of the change in the industry, and the industry is moving to an import model. And again, what better place to supply that import model, but with a factory on our doorstep in PNG. I guess to wrap up on that thematic, those of you who are watchers of the industry, Adelaide Brighton's obviously been a juggernaut of the Australian lime industry for more than 50 years. They've supplied Alcoa for that period, but last year Alcoa terminated part of that contract and has now moved to an import model. Fundamentally, why did Alcoa do that? Well, probably one reason would be they were sick of Adbri's monopolistic style of behaviour, but importantly, Adbri's quality and costing just didn't meet their requirements, and hence why they've gone to high quality, better materials on imports. Just quickly on ESG, I think we do have a huge step up on the ESG side. One, we've got access to gas. Two, we can generate close to 60 megawatts if we want to of renewables on our ML. We've done the studies. And three, we've got opportunities for carbon offsets in PNG. I've been given the bell. Just very quickly on Maya Iron, keep an eye on this. We've recruited Richard Seville as the chairman of what will be Ortis Resources, and Simon Slazerowicz, and we're looking to IPO, sticking with our disaggregation strategy before Christmas time. Very quickly on the project, it's in the Gulf Province. That's us building the early pre-mobilisation camp back in December 2019. So we're already on the ground doing things. Very, very simple, low-cost operation. As I said, we'd be putting iron magnetite units into China for $40 a tonne, and I don't need to tell you what the price of iron in China is for you to work out the margins, but it's certainly in excess of $100 a tonne. And we also have the Blue Sky project of Amazon Bay, which is the vanadium project I spoke about. Look, very, very quickly as a wrap-up here, energy and power. We see a huge opportunity in PNG. We're not going to stop at a 52 megawatt power station in Lae. There's opportunities in geothermal, there's opportunities in hydro, there's opportunities in PV, solar, microgrids for the villages. And we're positioning ourselves to be able to get a foothold and a first mover advantage in the energy space as PNG looks to electrify its company. I will stop there, thank you. Sorry for going a bit over time.
It's all right, Tim. It was all interesting. Would you put your hands together for Tim Crossley?